Let's talk about the American tradition of co-signing a mortgage. A mix of love, family, and financial risk. It starts with good intentions. You want to help someone you care about buy a home. But that warm, fuzzy feeling can quickly turn into cold dread when you realize you're on the hook for their debt. Co-signing isn't just a signature, it's a legally binding promise that can haunt your finances and relationships. I'm Kris McCullough, a loan officer who's seen co-signing turn dreams into disasters. My goal? To arm you with the knowledge to protect your financial future, even from the people you love most. When you co-sign a mortgage, you're not a backup. You're equally responsible for the loan. If the primary borrower misses a payment, the bank comes after you, and your credit takes the hit. This debt appears on your credit report, affecting your ability to borrow for anything else. You don't own the house, don't get to live in it, and have zero control, but you own all the risk. The bank sees you as their safety net, not a silent partner. Co-signing isn't a favor, it's a full financial commitment. Before you sign, remember you're not just helping them get a loan, you're getting the loan with them. Let's talk about the debt-to-income ratio, or DTI, the silent killer of your borrowing power. When you co-sign, that mortgage payment counts against you, even if you never pay a dime. Take the Johnsons, they co-signed for their daughter, then got denied for their own investment property because her mortgage counted as their debt. Lenders don't care who pays, they only see your name on the loan. Even if you prove the other person pays, some lenders still count it against you. Co-signing can trap you, blocking your own financial goals for years. Before you help, ask, what if you need your credit in the future? Over family dinners, co-signing sounds simple, but no one talks about the real risks. If the borrower loses their job, divorces, or disappears, you're responsible for the payments. Missed payments torch your credit, and you might not even know until it's too late. If they sell or refinance, you're still tied to the loan unless they qualify a loan. You lose control over your financial future, relying on someone else's decisions. Co-signing is a gamble with everything to lose and little to gain. These aren't rare scenarios, they're real risks you must consider. Still thinking about co-signing? Watch for these red flags. No concrete plan for getting you off the loan? That's a deal breaker. History of financial irresponsibility? Walk away. If they won't share their finances or get defensive, that's your answer. Emotional blackmail, you're the only one who can help, is a huge warning sign. This isn't about love, it's a business decision with real consequences. If the conversation feels like a hostage negotiation, run. Is co-signing ever a good idea? Rarely, but sometimes yes. Only consider it if there's a clear, written exit strategy, reviewed by a lawyer. The borrower should have stable income, good money habits, and a short-term predictable need. You must be able to cover the payments yourself, without stress. Don't plan on using your own credit for years. Trust and open communication are non-negotiable, backed by legal documentation. If all these stars align, co-signing is still risky, but not catastrophic. Should you co-sign? Let your head, not your heart, decide. Talk to a qualified loan officer before you sign anything. Get a clear picture of how co-signing will impact your finances and borrowing power. Insist on a formal, written agreement outlining the exit plan and responsibilities. If the borrower resists, that's your answer. Protecting your credit and retirement isn't selfish, it's smart. Sometimes, saying no is the kindest thing you can do. Get advice, ask tough questions, and always protect yourself first.